The key is to take more reward for every unit of risk. We need to take risk in order to make money in the market, but we need to make sure that we're getting properly rewarded for the risk we take. Hi, everybody. Courtney Smith here with our weekly video newsletter, TradeSmith. And of course, this tells you all the incredible risk you're taking if you invest in the market. So live it, love it. Okay, listen, right now the situation is I don't think that we're getting rewarded for the risk that we're taking in the market. So I believe we should keep a pretty tight lid on this. There's some things that disturb me about the market, but we should start a nice bull market coming up pretty soon. But it hasn't happened yet. Let's take a look at the price action here on the S&P 500. It's drifting lower. More importantly, the purple predictor just broke to new lows, suggesting that the smart money is already bailing out of the market. This is bearish. Now, I put a purple line across the middle of the chart at about 2115 on the S&P. And if we break that, we've got to get short the market. We've got to get short the market. So that's our action line. Now, as long as we stay above that, I think we need to be playing this from a bull side. And the reason is because of the seasonality should be kicking in bullish. Let's go a little bit further. First, the Dow Jones, same picture, only worse. Here's the NASDAQ, same picture, only better, which tells us that if we're in the bull side, we've got to be long technology stocks, NASDAQ type stocks. There's an old principle, buy that which is strongest, sell that which is weakest. And clearly, the strongest is the NASDAQ of the three major indices. Now, seasonality, this is at a critical juncture. This week should tell the story. This is the IWM, and the way we use that is that we know that starting October 1st is seasonally the best time of the year, from October 1st to April 30th. So what we should be doing is we should be seeing higher highs and higher lows in the market, and we're not. If we break that low at 119.50, that means we're clearly making lower lows. Now, why that's so important is because if we've got bullish seasonality and the market is breaking down, that's double bearish. And the reason is because when there's bullish news and the market reacts bearishly, that's super bearish. So this line at 119.50 is a critical line for us to watch this marketplace. I don't expect it to break. I expect the seasonality to be normal. That's what we should always bet. And that would mean that the market should start to take off this week. So really, once again, a very critical time, a critical juncture in the stock market. We've talked about this a lot from Stock Trader's Almanac. I think the blue line is still the correct line that we need to follow. And you can see we should be bottoming out here in the middle of October and then start a nice quick run up to the end of November. Well, 3-4% on the upside. That's what I think is most likely to happen. But I showed you that red line on the previous chart. If we break that, then throw this out and I'll start looking at the black and the orange lines. Okay, yield curve not telling us much, keeping a cap on the market, not allowing us to have a big bull market. Asset allocation, dribbling sideways. Risk indicator, dribbling sideways. Is a pattern developing here? Global shares, who cares? Better off in the U.S. than in global shares. Japanese shares, still bullish. Bonds, now take a look. Let's stop here for a second. We got the rally up due to the RSI divergence where we made a new lower low on the price, but not on the RSI. And I told you last week we should get a rally this week. We got that rally. But at the same time, volume was not very strong, just really one up day. But generally speaking, volume went down, which means it did not confirm the bull move. So I think this bull move is coming to an end, and we're going to start to see bonds go down, interest rates go up. Now, here's our key indicators, and 2 out of the 3 key indicators are telling us that interest rates are going up. The one that's going down, by the way, that's gold. But if interest rates are going up, That's going to help out the US dollar. And sure enough, the dollar is strong. I've been excited about this since we broke that horizontal green line. What we're seeing is the higher interest rates in the United States, the stronger economy in the United States than other places is causing money to flow into the U.S., supporting the U.S. dollar. Nothing is going to change about that in the near term. So look for the dollar to continue to remain strong, particularly against the euro. Why the euro? Because there's now other countries are talking about exiting. Frexit from France and Italexit from Italy, and so on and so forth. So the very foundations of the euro are under pressure. Second of all, I don't have the chart here, but the U.S. is actually tightening monetary policy while Europe and Japan are easing monetary policy. That means more supply of euros, more supply of yen, less supply of dollars. Well, all you can get is a bull market in dollar. When that happens, look for it to continue. That means that gold will be under pressure. Strong dollar generally equals weak gold. Why? Because gold is really a currency. Now, the other thing, I talked about the seasonality in the stock market. Let's take a look at the situation here. We've got bullish seasonality in September, October is the two strongest months of the year for gold. Oh, wait a minute. They've been collapsing. Once again, if you see bullish news, if the market normally goes up during September and October and it goes down, what happens when the bullish seasonality is over? The market goes down even more. So look for gold to be weak. I hate to be weak gold. But, look, I'm a gold bug on some level, but I'm not a fool. So bail out of your gold. It's not time to get there yet. We'll get there, and I will guide you into making 1,000% returns on junior gold mines. But the time is not now. Now, our indicators are neutral when it comes to gold. So I'm not really looking for a big bear market in gold, but I am looking for a dribbler. Now, oil, I think we're at the top of the range. We got back here back in June. I think we're going to peel off and start to go back down again. We made higher highs this week, but look at the green line. The RSI did not. That RSI divergence says that at least early in the week, we're going to see lower oil prices. All right. Thank you very much, freebies. Love having you here, but you should go to that website up at the top. It's a peanut. Get the real recommendations, get some more analysis. It's $47 a month. Just go to that website up at the top. Spell it exactly the way it is. Another thing coming up, got to remind you, go to that website up at the top. This is the premier stock trading education. I'm going to teach many of the techniques I used to create the #1 performing mutual fund in the United States. And oh, by the way, the #1 stock picking newsletter in the United States for 5 years. And oh, by the way, gold and bond market timer as voted by Timers Digest. So I'm going to reveal some of those techniques at that course. It's a live seminar. It's a peanut. Go to that website, get all the details. And hey, thanks very much for being here, freebies. Love having you here. Tell your friends, help us out, show us a little sugar. Go and tell your friends to get the free version. If not, sign up for the paid version. All right, fully paid up members, stick with me for a second and we can get into some of the new trades that I've got this week that I'm pretty excited about.